Hi, and welcome to On Point, a podcast by Oak Street Funding, where we bring research and data backed insights to dig into the minds of industry leaders to learn how to stand out and navigate and break through this ever changing industry. I'm your host, Bridget Height, and you can support this podcast by following us on Spotify, Apple Podcasts, on our website, or wherever you get your podcasts. We will be there hanging out, talking to industry leaders, and ready to empower you to grow your business. Now, let's get on point. Today, I am delighted to welcome Rob Roach to the show. Rob is Director of Underwriting at Oak Street Funding, and we are going to be talking a little bit deeper into the topics of our webinar, Beyond Underwriting, Strategy and Insights. Rob, thank you for being here today.
Well, thank you for being here as well.
Oh, well, thank you.
Great to
very
be
much.
with you.
All right. So in the webinar, we will briefly touch on the 5C's of credit and good business practices. We thought it'd be a good idea to dive deeper onto those 5C's for our listeners today. So we'll just jump right in. The 5C's of credit are character, capacity, capital, collateral, and conditions. So starting off with the first C, character. Can you discuss why character is so important, even though it's hard to quantify?
It is very hard to quantify. Character is one of the things we really start off with. First for me, it's finding out, is this a client we really want to work with? And I think that's, it's very hard to quantify. You're absolutely right. And so, using the tools that, we have at our disposal, one of the best of which is, your history and how you performed in the past.
Okay.
And so, that's one of the things we're really looking at, especially when we're lending on a national platform. We don't have a lot of times the opportunity to know somebody real well before they come to Oak Street, looking for a relationship. So, looking at how people have handled their credit in the past, how people have, dealt with their finances in the past is a great way for us to really put together a picture of, what this relationship will look like. I was trying to think of a good example.
Okay.
The example I could think of, when my family sends me to the grocery store, they know there's probably a 50% chance I'm going to get it right. Much less chance if I don't have a list. And so I always go to the grocery store with a list, and I'm going to be 50% right if I have that. And I'm 90% chance I'm coming back with candy. And so, so I don't get sent on the important task. And so, that's kind of the things we're looking at here is, what's your history tell us?
Right.
And what can we gain from that? And that's why it's so important.
Great. Thanks for that.
Yeah.
So how much weight does a business owner's personal credit history hold compared to the business's credit history?
Yeah. One of the things on the commercial side of the business we really focus on is the business and how it's operated in the past. I would say that, for the business owner, in a company or a firm that maybe has one or two owners, that business owner's personal financial picture, how they've handled themselves in the past, is very important to me. That's something that I can look at and say, well, if you haven't done a very good job with yourself personally, how is that going to impact your business? Because, ultimately, if I own my own business, that business and myself are one and the same, essentially. It gets a little less as, maybe there's multiple people involved. You have multiple owners. Maybe you're a CEO that, has this, you're a fantastic marketing person. You really can sell the product. But maybe from a financial standpoint, you're not that strong. But have you hired somebody that is that strong that can kind of keep you within those guardrails?
If you surrounded yourself with people,
that's right, exactly,
that do make your credit stand out. That's great.
Yeah, and so those are the things that we're looking at. So it is important.
Okay.
What I try to do myself is when we're talking about a particular firm or I try to start to set expectations of what I think I'll see. Mm-hmm. And, if you've owned a business for 25, 30 years, I would expect certain things.
Right.
And if I don't see those things, then, whether it's on the personal side or the business side, I start to wonder, why are we not seeing the things that I expect? Mm-hmm. And sometimes there's good reasons. Sometimes it's, hey, this just hasn't worked out. And so those are things we're really trying to uncover.
Okay, great. Mm-hmm. So now sometimes newer business owners might have a limited credit history.
That's right.
So how can a business owner with a limited credit history build trust with lenders?
Yeah, I think starting relationships, that's one of the things I think we really strive for. We don't want to be a transactional lender.
Right.
We don't want to make a loan and, that's the only thing we ever do. And so we really want to build that relationship. So starting the relationship even before you need money is very important. Reaching out to somebody just to get to know just to start to build some trust, build some rapport.
And how do you do that?
I think it's getting to know people, whether it's at conferences, whether it's,
Okay.
getting to know people, using your network to kind of grow your own personal network.
Okay.
Finding those people that, you might want to work with in the future, because
Mm-hmm.
it's it's so much easier to have those conversations when you don't need a loan sometimes, to when you're panicking and really starting to move forward. And
Right.
I need to get something done quickly.
Right.
Because if you do have that limited history, it's really
Mm-hmm.
hard to walk into somewhere and say, I need a loan and I need to get it done fast. And so that's where, having that relationship established early on is a very powerful thing, because, if you do have that limited, if you're new to the business and have
Mm-hmm.
limited transactions, you don't have that history built up, just beginning those relationships and, showing that you've been successful
Yeah.
up to that point are important.
That's great advice.
Mm-hmm.
So going off of that, are there alternative ways to demonstrate a strong track record of financial responsibility for businesses without a long credit history?
Sure. I think one of the things, I look at is, we talked earlier about how does your personal situation flow in. If you have, maybe you're starting a firm, so maybe your firm is new, but maybe you've been in the business for 30 years or 20 years. You've done really well in the past. Can you show me you've done well in the past? And so, those are the things that we're going to look at with somebody that doesn't have that history, or a firm that doesn't have that history. Being able to just, do you have you built a war chest up? Do you have a lot of money saved up? And again, it's showing how you've performed in the past.
Yeah.
It's kind of helping me put the picture together if I can't readily just look and see what it is.
Got it. So how does Oak Street Funding assess character? What makes good versus not good character?
Yeah, how we look at it is, really, again, looking at your history, looking at how you've done, how you've worked with us. And it's building that relationship. One of the things we do that is unique, especially when assessing character, is, our underwriters are involved with the client as well as our sales team. And so building that relationship with the underwriter, having those conversations on a personal level,
Right.
I think really helps us develop that character picture of your business and you. And so, those are the things that we're looking at. We're looking at financial statements as well. We're looking at, again, how you've handled things in the past. Are there things that we're finding that, maybe paint a different picture than what you're telling us sometimes? Those are the things we're looking at. And more often than not, it's just that relationship building. It's,
right. It's personal.
It's personal. It is. It's very personal. It's, have you done in the past what you said you're going to do?
Okay.
And, do we feel that we're going to be a good partner for you and a good partner for us? And so it's really, figuring that out, because a company is, it's people. And that's kind of what we're trying to find out.
Great. So we'll move on to our next C, capacity. So can you review what capacity really means for our listeners?
Yeah, capacity for me is, what is your firm's ability to repay our loan? It's simple. We're not launching rockets to Mars. It's what kind of, what's your ability to repay our loan? And so, what we're looking at there is, we're looking at really two things. So we're setting guardrails that really help us to identify what that capacity is. And the first one being, what is your company's, funded debt to EBITDA? Something simple like that. What's the debt load compared to your earnings? And so, that's kind of giving us a guardrail to say, how much are we willing to leverage up your company?
Right.
And the second side is, aside from that, is, what's your ability to cover the payments on that debt with your earnings? And so, using those two things, we can kind of back into a loan amount that we would feel comfortable with, a loan amount, your capacity to borrow money.
Okay.
Now, it's interesting. It seems like it all comes back to character. One of the things, I think ties well with this is, when we're looking at these things, when I'm looking at these things, we're looking at the people behind as well. What are your personal capacity? What's your personal capacity to support this debt if things don't go the way in your firm that we were hoping?
Okay.
And so, if the bank is the only source of money, if things go wrong,
right.
My view of your firm's capacity might be vastly different than what a business owner might think theirs is. Whereas if I know that our partner, our borrower, the person behind this firm has the capacity to support this business if things don't go exactly right. Maybe I'm willing to say, hey, your firm's capacity is a little more.
Okay.
And so those are the things we're thinking about when we think capacity.
Okay. So what financial documents does Oak Street Funding typically request to assess a business's capacity to repay a loan?
Yeah, it comes down to the financial statements. It comes down to, a borrower's income statement, their balance sheet. How much leverage do they currently have? There's instances where, a firm is bringing in a lot of maybe some existing debt. And so maybe they want to make an acquisition. And so we're going to throw that on what they currently have. So what's that going to do to their firm? And so we're utilizing, their financial statements to review that. We're also using in an acquisition, what do the seller's financial statements look like? What is this going to bring to the, our borrower? So we're going to bring a lot of debt. So hopefully it's going to bring a lot of earnings too. And so, those are the things that we're looking at. There are instances where, we've seen firms that their capacity has been completely taken to a point with maybe another lender to where they can't leave because this, whether it's a custodian, whether it's a carrier, whoever maybe has given them a loan that is, so over leveraged their firm that sometimes it's really hard for another lender to come in and take that debt out.
Right.
And so those are the things, if I'm a business owner, I'm thinking about, how much leverage is my company being put under? What kind of strain is the debt going to have on my company?
Yeah.
And so it's important things to think about and talk to your lender about.
So, but how does this allow us to lend differently than others?
I think where we look at, and this is going to blend in, I think, to another one of our C's later.
Oh, okay.
Where we see capacity is as a cash flow lender, we're looking at the cash flow.
Okay.
We're looking at these operational metrics where a lot of lenders, a lot of traditional banks are going to focus more on collateral sometimes.
Okay.
And so, we're going to be looking at that cash flow that's being generated from your company, from another firm, maybe you're buying, what that combined entity is going to look like. And that's one of our strengths here at Oak Street is, our ability to look into the future and say, okay, you're making an acquisition, or maybe you've made some kind of a change to your business. What's that change going to produce in terms of cash flow? And let us leverage that cash flow in that way.
Okay, great. So what are some strategies that businesses can employ to improve their debt to income ratio and increase their chances of loan approval?
Sure. First is real easy. Make more money. It's simple. And those are one of the things, obviously making more money, but I think it's being very diligent on, making sure that you're maximizing your cash flow.
Okay.
There's a lot of companies that are maybe, running some things through their business that, we use ad backs occasionally, but we don't like to use ad backs. Okay. And so, but utilizing those and making sure you're maximizing your company's cash flow, as well as, making sure that when you are borrowing money, you're borrowing it prudently. You're not over leveraging your company at a certain time that makes it very hard to, borrow more money when you have a real need that comes up.
Okay. So let's move on to our next C, which is capital. So can you explain what you look for in capital?
Yeah, absolutely. Capital, when we think about that, it's, the equity in the company, the equity that our borrower, the person behind us is actually going to be putting in. When we're looking at that, that frees up capacity, right? Because sometimes the more capital that's behind you allows us to loan more money.
Right.
And so, that's what I look at. It can help with terms. If you have a large amount of cash on the sidelines, maybe it helps us to do some things that we normally wouldn't do.
Okay.
And it can help us, to make things a little easier for you sometimes.
Okay.
And so, really it's a buffer for us. More capital that the client brings, the less risk for us, the less loan size. And so, those are the things that we're looking at. And when they help our metrics, they help our borrowers' metrics. And that's what we're looking for. Something that, gives our borrower, the ability to sleep well at night because they're not overburdened with a loan. They have an appropriately sized facility and, keeps us in good graces with the people who look at us all the time. And, so those are the things we're looking at in capital.
Okay. Thanks for explaining that. So now, how much skin in the game do lenders
Mhm.
expect business owners to have invested in their own company?
It really depends on the situation.
Okay.
For an acquisition, there's the ability to have no additional capital. Maybe
Okay.
you have a firm that hasn't borrowed before, and we're going to use your equity in that firm kind of as skin in the game.
Okay.
There's a lot of times maybe we are going to ask for some contribution. Maybe you're making an acquisition, and maybe we will ask for 5, 10, 20%, as a down payment kind of into the acquisition. And those things are the things that help us to lower our ratios, lower that loan to value, lower that loan to cost when you're buying something.
Okay.
And so whereas say a working capital line of credit, maybe you're looking for something like that. We wouldn't necessarily expect an owner to put some money in if you're looking at working capital,
Right.
necessarily. Okay. So it could depend on a lot of different things, but we definitely encourage our borrowers to have some skin in the game to create that alignment that we're all on the same page.
So what are some ways that a business owner can demonstrate a strong
Mhm.
personal financial investment in the company beyond just their initial capital contribution?
Yeah, sure. For us, one of the things, we think about is, you know, and we set up our covenants sometimes this way is, how much money has a customer left in their business as
Okay.
time has progressed? Is it a company that the firm is being, its income is being taken out by the owners every year, or are the owners leaving some cushion in there, building some cash in the firm, building some
Okay.
of that equity. Those are the things that a business owner can really use to can show me that, hey, I'm not in this business to just take everything out of it.
Right.
I want to grow it. I want to be for the long term. I want to set us up for success. And that obviously it's their business, that they can run it, kind of have, run it. They're in business to make money.
Right.
And so, we understand that, but it's just making sure that, the commitment is there to leave some of that capital in the business.
Okay, great.
Mhm.
Okay, the next C is
Mhm.
collateral.
Yes.
So what does collateral mean in general underwriting terms?
Yeah. And I was thinking about this question, for a lot of people, for a traditional bank, collateral would be something they would look at, and you would have a piece of real estate, you would have a piece of maybe a building, something that can't move, can't walk away.
Right.
And so, that's why in the industries we're in, it's sometimes very hard for banks to look at a loan, for an insurance agent, for an RIA, a CPA, what have you. And so the way that Oak Street looks at the collateral is a little bit different. Being a cash flow lender, we're looking at our collateral is the value of your firm.
Okay.
It's the value of those recurring cash flows that you have year in and year out. And so, we're looking at those, and, that's one of the things we ask for. A lot of stuff sometimes. We monitor a lot of things sometimes, or a number of things that people might be surprised at why we look at things the way we do. And the reason is, our collateral can disappear really quickly.
Okay.
And so we want to make sure that we're working with that business owner to monitor, how they're doing, what their books look like,
Right.
the consistency of that recurring cash flow, because that's our collateral. And we want to make sure, obviously it's maintained for us, it's maintained for the borrower.
Is Oak Street Funding's approach any different? Do you feel like we do anything differently than others?
Yeah, I think we do it better, obviously, but no, I think, we look at some things a little differently than some other lenders.
Okay.
And I think that allows us to provide some terms that are maybe a little different than others.
Okay.
An example, I think we'll see a lot of clients that maybe have had a loan with a small town bank, a hometown bank, and they quickly outgrow those loans because at some point somebody at the bank is going to say, wow, there's not a lot of collateral here. And so, the way we do it is, being able to open that up and allows us to lend a great deal, a much larger amount than a lot of other banks will do.
Okay. So we've made it to our last and final C, which is conditions.
Sure.
So can you discuss what conditions means?
Yeah. Conditions really are the things that are, in your business that, and can affect your business. And I'm probably not doing a very good job of this. So I'll go into some examples of that. How long has your company been in business?
Right.
That's one of the things we're looking at. Is it a new business? Is it, something you've just started up, or has it been in business for 20 or 30 years? Your industry, what's happening in your industry. Are there, for our RIAs, what's the market doing?
Right.
For, insurance, is it a hard or soft market? What are carriers doing? So those type of things. What's the regulatory environment that we're looking at as things change with the government? The overall economy, how is that impacting our clients?
Right.
Presidential elections, who knows how that's going to impact things, right? And so we're, looking at those things. Our bank's chief credit officer, he has a great way of putting it. What's your right to exist as a business? And, what meaning this, what is your right to exist for, what are you doing better than everybody else? If you're an RIA, what are you doing better than other people that's allowing you to succeed?
Okay.
And how does that impact your clients? How does that impact your shareholders, as well as other stakeholders? So, how do you compete and what makes you successful? And so, those are the things that we're looking at and kind of putting that whole picture, into play when I think of conditions. And, some of those might affect, banking. How are we in a tough credit market? Or are we in a good credit market?
Right.
What does that look like? And so when I think of those, we're thinking of all that as rolling up into one, and trying to help us again as we try to predict, how a firm will be in the future.
You really do have to have like a crystal ball of sorts.
It is, and it's not perfect, and that's one of the things I think we do a good job at Oak Street of is we realize every relationship's unique, every firm's unique, and that's why that building that personal relationship is so incredibly important, is to help us understand our client's position in the world and how things affect them so that we can react appropriately as well.
It really does all come back to character, just like
it does.
Yes.
Yes.
So how can a business owner tailor their loan request to align with the specific loan products and conditions offered by different lenders?
Yeah. I think being very thoughtful, being very intentional with it. I think, speaking to one of our relationship managers, salespeople, early on, I think is very important when you're initially thinking about that acquisition.
Right.
Reaching out and building that relationship first, letting someone know this is what I'm thinking early on, so that you can help you can structure your request. You can structure your business sometimes, because sometimes it's years out before you're going to do something even. So maybe years out you want to start structuring yourself to where you can absorb an acquisition. Your finances are to the point where you can successfully navigate that. And having those conversations early, instead of coming to a lender at the 11th hour saying, hey, I have an acquisition that's closing in a month, what can you do? That makes it very hard.
Yes. Okay.
Yes.
Well, you have officially covered all of the C's.
All the C's.
Credit for us. Thank you so much, Rob.
Yes.
So this question isn't directly related to the 5C's, but what skills will be most in demand for future underwriters, and how have you seen the industry change?
Yeah, that's great. I think, there are so many more tools available to us.
Oh, right.
Now than, when I started, 5 years ago, I'll say, but more than 5 years ago, when I started, we were just coming into that cusp where, we had computers, but we really didn't know what we're going to use them for.
Right.
And so, email was about all we did, but, now we just have access to so much more information. And so, having an underwriter that has the ability to, wade through that information, aside from the financial statements. We've always had financial statements, that financial analysis, but having someone who can successfully navigate through infinite electronic information.
Do you think it makes your job easier as an underwriter to have all of this information at your fingertips, or does it make it more complicated?
I think both. Because it's much easier for me to Google somebody's name and see what comes up.
Yep.
So we have that, but then there's also this feeling of, when have you done enough?
Right.
You can keep going forever, it seems like. And so, I think it makes it a little easier to find information on people, to find information on firms, and to verify a lot of information. But it's overwhelming for a lot of people. It's overwhelming for me.
Yes.
Because, as I think one of the last non-digital natives, still learning a lot of a lot of the abilities of some of the software, learning the abilities of, what's available. And then, having a 500-page spreadsheet given to you. It's like, what do I do with this? And so being able to just kind of filter out that information and get to the important things. I think that's going to be a skill that, it's going to be very valuable in the future and continue to be very valuable.
Great. Well, thank you for all of this information and all the discussion about underwriting following this webinar.
It's very exciting.
It is very exciting. And you clarified so many things. So
Great.
At the end of the show, we do like to ask our guests a fun question. Rob, if you were a professional baseball player, what would your walk-up song be?
Wow. Eye of the Tiger. I don't know. Let's go back to the 80s. Yeah.
That's a perfectly good answer.
That's a great answer. Also, that was the first one that came to my head.
All right.
That would be great.
Thanks, Rob. Thanks for being here. I learned a lot, and I'm sure our listeners did too.
Thank you.
Thank you all for listening to On Point, a podcast by Oak Street Funding, where we bring research and data-backed insights to dig into the minds of industry leaders, to learn how to stand out and navigate and break through this ever-changing industry. I'm Bridget Height, and tune in next time wherever you listen to podcasts as we get on point. Don't forget to subscribe and leave us a review. Thank you.